Tushar Pradhan, Chief Investment Officer at HSBC Global Asset Management, joins us right now for a perspective as well. Tushar, good having you. Thanks for joining in. What's your sense, Tushar? Are valuations pricing in the worst, or is it difficult to call right now?
Well, I think difficult to call in any stretch of the imagination because there are too many things happening at the moment. So it's just not one crisis we are facing. So whether it's the crisis of the epicenter shifting to Europe, whether it is the massive incentives that the U.S. Is pumping into the market and, the impact that is likely to cause, the overall slowdown that we're talking about in the world, which nobody really has a clue in terms of which direction it will go. Domestically, we've got our share of problems apart from the virus scare, which is the banking system, the current situation around certain stocks, so on and so forth. So I think it's a perfect storm in that sense that one really cannot, look at what is the upside here and what is the likely path, out of this problem. So I think volatility is clearly going to be the name of the game. And as we saw volatility as on Friday where we were and where we are today, I think that is what I describe as volatility. There won't be any direction as such. There will be a stream of news which will hit us. And I think the markets are just going to be reactive in the short run. And I think this is going to be probably the norm for some time at least. That's my understanding as of now.
But Tushar, good morning, Devina here. Do you feel that the market has factored in most of what we're talking about right now in terms of the full impact of coronavirus? The way we have fallen from the highs, currently we're just about 45 to 47% from the 2008 highs in January that it made at 6,300. So, the scale over the last 12 years is giving you returns of about only 45%.
Yeah, there are two things here. One is what we call as fair value, and one is what we call the market price at any given point. They generally don't meet most of the time. They're away. Either the market gets euphoric about the prospects and it goes far beyond fair value. And on situations like these, because the scare is there and because the sentiment that rules, your prices are going to be much, much lower than whatever you can imagine to be fair value. So there's no debate on the fact that, this might be attractive. But attractive to whom? Because you understand that investors will look to safe havens. They will look to store capital. And for them, any price is good enough to wherever it can halt the capital depreciation. So I don't think we are talking about fair value. We are talking about where the markets are headed, which I think is a different question altogether. So I think if someone really keeps a calm head and says, look, my investment horizon is the next 5 years, I think these are great times. But as I said, whenever these times come about, the environment is not something which is supportive. There's nothing there in the narrative which you will be very positive about and to say, okay, this is the time to buy. There is nothing there in the narrative which will tell you. But I think if you know the asset class well enough, if you think, the terms match, if you have the waiting power, if you can ignore the current news, which is always going to be very difficult. But I think that's really the perspective one needs to keep at these times.
Right. It's really difficult, Tushar, and rightly put out there. But, for a retail investor, while you may want to, stay on the sidelines, protect some capital, it's difficult to ignore the attractiveness of the prices. So in light of that, then what should the strategy be?
I think it should be pretty much determined by the investor himself or herself, because what is really important at this point of time is to know the term, the ability to hold on, and what is the horizon that one is talking about. Many investors have different horizons, and that's why there may not be a one-size-fits-all kind of situation. But yes, clearly there are tremendous bargains out there as you speak in the terms of, the attraction of the valuation. Given that the situation is, suppose you give a scenario that situation is going to normalize in some way, maybe 1 or 2 months down the line, then clearly these are great values. But there is always a probability that these things could drag on, and maybe could you find them the better price? Of course. So I think timing is always going to be very, very difficult. Nobody disagrees that anything at a discount to where we were even a month ago is a clear value, and the attraction very much is there in the market. So it's up to the investor to decide it.
Well, we are 6% down now for the Bank Nifty, 1,560 points, and the Nifty and the Sensex too down 5.5% apiece, so it's not looking pretty at all. Tushar, just one technical question on a Yes Bank. I'm not asking for the stock view, but I'm asking that there are index funds which would be housing Yes Bank in the fund, and if once Yes Bank goes out of the index in a few days from now, how do mutual funds tackle that issue? Because you will necessarily, or funds will have to necessarily get Yes Bank out, but there is a lock-in on selling more than 25% of Yes Bank.
Well, I think that's a technical question best left to the experts.
Okay, fair call.
I don't have any exchange funds as such, so I really wouldn't know. But my guess would be that anyway, the value can be adjusted later on for a purchase and that will be the combined index available for people to buy. So if there is a lock-in, there's a lock-in. I don't think any investor can do anything about it. So it'll just stay there, and the new entrant is possibly just going to be the one which will be bought.
Okay.
So the percentages may be identical for a while, but I'm sure that's the current situation. That's how it will work.
Fair call. Tushar, one final question from mine at least. There are notes that have come in which speak about how the Indian large-scale financials, Bajaj Finance, for example, has gone out and said they haven't experienced any issues with regards to the economy or the COVID-19 situation thus far. Do you reckon the markets are pricing in some fears for what could come ahead, and that's why these stocks are getting punished, and therefore is the pain in the price?
Yeah, as I was just mentioning even a few minutes ago, that is clearly one of the indications that nothing really from a fair value perspective, fundamental perspective really justifies the price which is at, which means it is just combining some sort of fear inside of the price. And who's to say that if the fear goes away, will it shift back to fundamental value or more? It is always likely. But as I said, since the fear part and the uncertainty is very much out there, very difficult to call whether that's, the bottom. That's really what I'm coming to. One can really look at relative value, because clearly some companies will be more affected than others when the slowdown as an impact of the virus directly comes. There will be companies which will actually even benefit from, the changes. And there will be companies which largely will remain indifferent to whether, the scare is there or not. Technology, for example, to a certain extent, will remain a standard cost for most people, no matter what happens. So I think when you look at all of that, there is a plethora of valuations and plethora of opportunities. So it may not be just this one thing that, look, everything is a discount, so one should go out and buy. Clearly, some cases will be much, much better than others.
We'll leave it at that. Tushar Pradhan, thank you so much for taking the time out and being with us.